So in the emerging VC space, this is one of these areas where 90% of the managers trying to launch a fund either spend way too little time on portfolio construction or too much time on portfolio construction. And both of these things are detrimental. My name is Mirto Lalikos, and I'm the founder of the Emerging VC. I spent the last 4 years running the program that launched around 60% of the world's new VC funds globally. And during that time, I became top voice on LinkedIn for amplifying content that relates to starting a VC fund or scaling a VC firm. And these two things in combination resulted me in becoming first degree connected with 20 to 25% of the active VC firms worldwide, which is a crazy number to think about. And I now launched the Emerging VC, which is an independent resource for emerging VCs where I curate and amplify the latest insights on launching and scaling venture capital funds. I'm going to swiftly jump to today's session. We are talking about portfolio construction today. And before I introduce our amazing speaker, I just want to say a few words on portfolio construction. So in the emerging VC space, this is one of these areas where 90% of the managers trying to launch a fund either spend way too little time on portfolio construction or too much time on portfolio construction. And both of these things are detrimental. If you spend too little time on it, most likely your fund model isn't going to make sense to limited partners. And the story may sound right when you kind of present it, but when you're an LP and you start digging into the numbers, they won't add up and you're going to be losing credibility. On the contrary, if you spend too much time on portfolio construction, then you're over-engineering and you're not out there fundraising, which is what you should be doing in kind of the first few steps of launching a VC fund. Both of these things can slow you down, if not severely impact your fundraising, either by losing limited partners or by not fundraising and doing kind of models instead. So that's why I'm so excited that we have Aram Attar here with us today, who is going to deliver a masterclass on portfolio construction for emerging GPs. Aram put together the most comprehensive on VC portfolio construction, which also includes a downloadable fund model that I have ever come across in my kind of time in this space. It really clearly demonstrates how every single factor of portfolio construction and every variable that is taken into account under the umbrella of what we call portfolio construction can impact what needs to happen on the ground to generate the required returns that you're going after when you're launching a fund. And just by way of introducing Aram a little bit further, he is the founder of the VC Factory and creator of the mindset-based investing principle. He spent 20 years in LBOs, growth equity, venture capital. He has completed more than 50 transactions across the 3 continents that he's moving around between before founding the VC Factory in 2018 to amplify the mindset-based investing method for how LPs should think about investing in emerging GPs. So big kind of supporter and, cheerleader of emerging GPs to LPs. And Aram, I understand you're an LP yourself, so you're kind of seeing things from that perspective as well. So Aram, such an honor to have you here today. Thank you for joining us. I will pass it over to you at this stage so you can further introduce yourself and go through the material that you prepared for everyone.
Thanks, Mirto. Love also what you're doing. Yes, I attended the last 2 sessions, really love it, and super happy to do that here today. So hi, everyone. What I'm going to do is the way I run things, usually I don't do a PowerPoint anymore because I think when you have a PowerPoint, people stop coming in, and I'd love to hear you as we go along. I just want to add one thing is that I talk a little bit about what mindset-based investing is, but it's true that it's something that can help you hopefully convince LPs to invest in emerging GPs. That's one of the angles. The other angle is to help you as GPs invest in founders, okay? And as you said, Mirto, I invested in a couple of funds. I usually sit on the investment committee, and I also invested in a fund of funds. So I'm trying to use my framework to guide my investments and hopefully put my money where my mouth is, my brain is, as I say. What I'm going to talk about today is very simple, why you should care. And Mirto did a great introduction. I'm going to show you one of the best investors in emerging VC funds, Biza Clarkson from Sapphire Partners, how she thinks about it. And that's the way I've been training VCs for 8 years now, online and in person. I didn't tell you, but most of what I do today with VC Factory is that I conduct a workshop based on VC decision making. So we are 3 or 4 to 5, and we talk about investment committees, about biases in decision making. So it's a lot of psychology of investment, right? And when I do that, I always show videos from people who are much smarter and experienced than me. And the white section is going to be around Biza Clarkson. And then I introduce to you the VC portfolio construction matrix, which is what Marto was alluding to. It's a very simple one-pager. Took me months to do because I wanted to train the GPs that was investing into this stuff, and it was really hard. And so hopefully it has a lot of problems, of course, but it's a good place to kind of see how every aspect of the portfolio construction works. This is the post that Myrto was alluding to. I'll put the link here. If you go on my website, you can download the one-pager for free. There's a whole guide. It's like 16 minutes to read, sometimes takes longer, and you have the one-pager here. So you can download the spreadsheet and should be very easy. Even my students can do it, so you guys will do it without any problem. So without further ado, I want to go into the why. And why, as I said, I want to introduce you to Biza Clarkson.
I'm happy to share it.
So a couple of years ago, I think now, she went on that podcast with Michael Eisenberg, who's a former benchmark partner who's now at Aleph in Israel. And he asked her, what's portfolio construction? He asked her, what are the criteria to invest? She was asked, how does she make decisions, right? And then she did the whole thing with the soup. And frankly, I feel for you because, someone here said, I have multiple thoughts of portfolio construction. And you're going to hear a lot of people talk about it. But then she was asked, what is the thing that if you don't do it, you're not going to raise? And she came up with portfolio construction. And I don't know how much you heard about it, but we're going to unpack it today. The idea is that what she's saying, and I'm going to show you other LPs and other GPs to talk about it. The question is, run the math. If your success depends on reaching outcomes that statistically have never happened, I'm not saying you're not going to raise, but it's going to be a tough sell. So the whole thing I'm going to talk about today is how to make sure that all your, assumptions on reserves and fund size and so on, what is the one number that LPs look at to see if it makes sense, right? And then you're going to have to compare that number, which is what is the biggest exit you need to have, to your investment strategy, your investment thesis. If you want a $1 billion exit to make your returns, do you have $1 billion exits in your investment strategy in the last 10 years? That's really the gist of the message today is, what is the one number that you look at and how do they compare it? What do you have to convince them of, which is you have to convince them of that it is doable. Yes? I was very curious when I started investing last year. I started investing in emerging GPs, and I was wondering, how can you circumvent the problem, which is what I call the emerging GP conundrum, which is that some of the best funds ever are fund one, fund twos. What I did was, but you don't have a track record, so it's really hard to invest in you. So that's a conundrum. What it is, I went and I looked at with a team of 3 researchers, my MBA students. We looked at what 3 people, Biza Clarkson, Michael Kim from Sandana, and Samir Kaji, how do they pick winners, right? And that's this article here. And we came up with an analysis of what are the top 6 criteria they look for. And one of the 6 criteria was the portfolio construction. So we looked at, hundreds and hundreds of blog posts and videos and so on. And that's where we came up with this portfolio construction matrix, which is very easy. You can see it on the website. It's just a one-pager, right? So what's difficult is not the modeling. What's difficult is getting the right assumptions right. And hopefully you can see that well. And, again, I'm not going to go into every detail now. I just want to give you a feel for how it works so that hopefully when you go back on your own, you can do that. The idea is just to start with a very limited number of inputs, fund size, reserves, and I'm going to show you a video on each of those, how top LPs think about that. Initial deals, entry, ownership target, dilution, exit from entry, and so on. And then the soup is that it gives you what is the biggest exit you need to have, given the power law, I'm going to talk about it, and given the statistics we see on emerging funds. And so what the spreadsheet gives you is the one number, which is what is the exit value of your fund winner, the one that's going to be really going through the power law. And then your job is to compare this number, 1.28. If you had a 40 million fund with all this strategy, you need to have a $1.28 billion exit. And then your job is to show to LPs, yeah, you know what? In my strategy, given my geography, my stage, my verticals and so on, yeah, there's 20 of those in the last 5 years. So, this is doable. That's the most effective way to convince LPs, because you're using numbers, you're not using an opinion, okay? Whereas, if you're using opinions, then you're on the wrong side of the checkbook, so, you're probably gonna lose. And many of you are gonna tell me, but Aram, I'm on a new strategy, it's a new market and so on. Okay, but you need to try and find reasons for why it's doable. Like why, maybe take an adjacent market, we can, do a lot of, you need to do a lot of kind of consulting work to show them it's doable. Spiros, the metrics, I think there's a link. Yeah, there's a link just there, okay? So this is the metrics, and what I'm going to do in the remainder of the next 20 minutes is show you how the top LPs in the game think about those assumptions, right? So hopefully you get convinced that this is how I build this, that hopefully you're convinced that it doesn't come out of thin air, but it comes out of best practice in the field, okay? And the first thing I want to show you is that all these LPs, they all said this one sentence: fund size is your strategy. If you haven't, it's really this idea that if you choose 5 million fund or 40 million fund, the exit you need to have is going to be very different, right? Actually, Mike Maples, a very smart guy, is one of the best investors in the game. I actually met him in Austin a few months back. He's a very nice guy. Also, he wrote a book very recently you can read. And he's the one who came up with this sentence, like fund size is strategy. So I'm just going to unpack that. I prepared this little chart. Basically, what he's saying is that 64-4 is the new 80-20, because if you look at the parallel, the idea of the parallel is that 20% of investments are going to generate 80% of your returns, right? And what he's saying, that if you square it, then you get to 4% is 64%. And by the way, there's a chart I didn't show you, but maybe you can see it on my website and elsewhere. It's really funny because the best analysis I've seen from Hursley Bridge, which is a fund of fund, on 30 years, 1984 to 2014, of funds is exactly what it's showing. It's showing you that 6% of investment in almost every US fund over 30 years returned 60% of the returns of the industry. So what he's saying is that if you have a portfolio of 25 startups, then 4%, one is 4% of 25, it has to generate 64% of the returns that you're promising. So if you have a fund and you're saying, guys, I'm sure many of you have that, with us, you're going to make a 5x return on investment, on invested capital. Then it means that one of those investments, the fund winner, statistically, right, is not a law, right? It's a statistical fact. And I have like a post with like 6 databases you can check. In every time you look at early stage, you get the parallel. Statistically, your fund winner has to make a 3.2x, right? So this is the number that I use in the VC portfolio metrics to give you what's the basic exit need to have. So I just want to pause here and get everyone's sense of, is it clear for everyone that basically fund size strategy means that the bigger your fund size and the bigger the exit you need to make the returns you're promising LPs. Is that clear, or do you disagree? By the way, I have a twin brother, so I've been debating all my life. So I'm very happy to have people who don't agree with me and can have arguments. I mean, I have just one version of the truth. So I certainly don't think I know everything. So yeah, if you have any questions, go ahead. Yeah, Myrto.
And I just want to add everyone too, and that's why a lot of, if you use Aram's kind of tool, it's very clear, but you'll hear it very often. It's easier to generate returns on smaller funds. That's why so many people that are wanting to launch funds, this is an error that we see. They work backwards from management fees, and they're like, oh, well, if I want to make this much management fees, then my fund has to be this big, and so but they're optimizing for the wrong thing. As an emerging VC, you should work backwards from the returns you can generate to LPs, because guess what? If your fund one doesn't perform, then you blow up, and likely you get pushed out of the market. You need to do something else in your life. So as an emerging VC, you can't work backwards from management fee. You need to work backwards from carry. And Aram is going to make it really clear, like, why smaller funds can generate larger returns. We have a question here, Aram. Where does the J curve come into this? J curve is different. It's basically, you call capital into the fund, and then there's management fees and all sorts of operating costs of the fund that takes value out of the fund. And then you start seeing kind of in the portfolio. And so the value of the fund and the returns for the LPs, the unrealized value kind of starts going up. So that's kind of the J curve, but it's not so much to do with the fund size so much.
Yeah, and by the way, I can show you, those who are wondering, I have this article on DPI, which I really encourage you to read. It's going to distress you guys because I've had hundreds, not hundreds, but I talked to 120 emerging GPs in the last few months, and like dozens pitch me, and everyone comes in and says, hey, guys, everyone is a fund too. Hey, guys, I have a Aram, I have a 0.6x DPI, whatever. And I was just before this, I was talking to my former colleagues, and they have billions in assets under management, and everyone's like scared with DPI. I mean, every time, I understand it's a market, but just to tell you, every time an LP asks you for DPI, they're probably 90% the wrong investor for VC. So maybe don't insist too much because it takes time to build great companies. And just if you go down that article, you'll see why. And also just to illustrate what Myrto was saying, you have this thing of the J curve, which is just that your portfolio is going to be negative in the beginning and so on. So if you're wondering, you can go to this article. Basically, you go to my website, you type J curve, DPI, whatever, you find it, or you add ChatGPT, which is faster. But so yeah, anyway, so it takes a lot of time to build. And that's why when I went through what those VCs were saying, those LPs were saying about how they invest into the emerging GPs, they're really saying, yeah, exit, you need to have a conversation on, are you going to do secondaries? Are you going to take money off the table? Are you going to do all that? But, me personally, I work on biases in investment decision making, right? So me, I'm super biased. I don't need exits. Actually, I'm biased against it. If someone's telling me I have quick exits, I don't believe them because I've been doing that for 20 years. And I think it takes time to build great companies. And also, just like Myrto was saying, I'm also super biased against people who want to raise 50 million fund because you understand I need to make a living out of it. I understand that you may need to make a living, but I really 100% underwrite what Myrto was saying. I don't think your fund size should be chosen by how much money you need to make, because unfortunately, if this is the first time you're doing this, you need to prove that you're a good investor. Unfortunately, it's not going to be this one you make money, probably not the next one, probably the one after that. That's why emerging manager is like 4 funds.
Yeah. And Aram, for those who download the Excel, if you double click on the values at the bottom, at the second half of the table, you're going to see the calculations. So the first part of the table is the inputs, and then second part of the table is like its outputs. That's where you find the calculation.
Yeah, the formula is plus and minuses. I mean, it's just that I don't want people to break the model, because every time I've done that, people send it back to me and say, oh no, but I added this one line. Yeah, of course, then it doesn't work, right? So far, we got to, why do you guys need to do portfolio construction? Because it's a credibility test for many LPs, right? 2, because, it helps LPs understand if you know how to make money and if your investment thesis makes sense with all the assumptions that you're making in terms of number of deals, average ticket, and so on. That's one. That's what we covered with Mr. Clarkson. Hopefully now you're on board with the idea that there's a parallel. It's a statistical fact. So most LPs will want you to show your fund winner, which is, again, 64% of your returns. Is it likely to happen? Because the exit you need for that fund winner, like the $1 billion or 200 million or whatever, depends on your fund size, right? So that's where we are. Now I want to keep going down the lines of the metrics, right? Which is reserves. Because this is something you really have to decide early on, and it's really tied to your number. If you have a 5 million fund, so I'm an investor in a 5 and a 25 million fund, they don't have the same reserves. At 5 million, it's hard to do reserves, right? But at 25, you can start having, a little bit of reserves. And how to think about reserves, what you hear from most of the LPs, 25 to 35 companies kind of makes sense. I mean, I've talked to GPs who have 12, and I've talked to GPs who have like 50, okay? And all I tell them, it's great, do it, just make sure you can defend it, because you're out of the average, right? So I'm not saying you shouldn't do it. I'm just saying if you do it, make sure that that's not the average. Every time I sit with other LPs in like juries or we talk to GPs, most of the questions that they ask, one of the first questions is, how do you think about reserves, right? Even people at big fund of funds. And I never really know how GPs should answer that. And I think one good answer is, hey, you know what? We're not going to invest in everyone. We're not going to do a programmatic. We're going to try, and it depends on the valuation, the uptick, and so on. But we're probably going to do super pro rata when we can, and then we take less than a pro rata if we can. So I want to pause it here, and I want to have your perspective on reserves.
So we advised against kind of having reserves in the fund altogether, because the point of a fund one is to get you to a fund two. The point of fund two is to get you to a fund three. Why? Because you're trying to get rid of a scarlet letter on your chest that reads emerging manager, because no big institutional LP with big checks wants to invest in an emerging manager. So basically what you're trying to do is just get out of that bucket. And so the way you do that is you launch a small fund one, no reserves, deploy that, get markups as fast as possible, and then go back out to market with a good story to sell fund two, and so on and so forth. And so the way you'd handle reserves and kind of doubling down on the winners is through SPVs. So you allow the LPs of the fund to fill their pro rata through SPVs, and it keeps you from kind of having this big fund that you're stuck deploying for a long time.
Love that. There's an article I wrote on the investment thesis, which really should be something you do before the model, right? I'm copying here something that a GP, which again was much more than me, said, which is that I totally agree with what Myrto said. When you have a small fund or fund one or two, you're optimizing for traction. So what you're trying to get is momentum, improve your investor. So you're probably better to make a lot of investment. Doesn't mean you spray and pray, right? But maybe it's better that you make those investments and then hopefully have some winners on paper at least, and then raise fund two. So that's optimizing for traction. When you're bigger, then you can optimize, he said for dilution, but basically for ownership mostly, and then you can play that game with reserves. That being said, I've met people who have been successful raising, 40 million fund ones, and, they chose that, they had reserve from day one. But most people are what Myrto was saying, you're going to raise 5, 25, 50, 100, and then your whole thing is to get traction, momentum, and show the world that you're a good investor and your investment thesis makes sense. Yeah, all these videos, you see the source in the main article. So always what I do is I put all the, so you have the links and so on. Okay, so if we go back now to the VC portfolio metrics, just make sure people follow, because this is a bit technical, right? I mean, it's not as nice as, hey guys, should we have reserves? But so what we've done so far, we said why fund size was important, because it's really your pole bar, like it's the pole vault bar, how high you need to jump. So the fund size is going to decide what your big exit is going to be. Your reserves, obviously, they're going to eat into your average ticket. So they're going to decide. So you can have zero, you can put zero in there. The number of initial deals, we talked about it, 20, 30. If you, again, I'm not sure what Myrto actually is going to have your, because you've seen so many funds, like every time you have a different perspective, super happy that you share it. So on diversification, quote unquote, because it's not really diversification. My point is, by the way, just one thing before I give you the mic is, in LBOs, I come from LBO background. So diversification was, we have a 2x deal and a 4x deal, and hopefully, we make a 2.5x on total, right? In VC, everything is like super risky. So there's no diversification in terms of risk, but it's, in terms of number of investment. So what's your take on diversification, Myrto?
Yeah. So we typically kind of say, you want to have as many shots on goal as possible. Obviously you don't want to overstretch it, because it goes back to kind of what we were saying about ownership. Typically the fund ones would start and aim between 25 and 35 hits for fund one. I was reading through your article and you said that, sometimes you get these GPs that try to convince you that going less than that, so like a 15 company portfolio or like 150 company portfolio, like there have been times where you've been swayed or persuaded that that's kind of the right approach. Can you give us kind of high level, maybe just like an example of when that has happened?
2 examples. One is really, really smart guys in Germany, micro fund, a few million, 2 guys who had worked at a VC firm before, and they chose something logistics that unsexy, super great. And what could convince me, I didn't invest, but I mean, they convinced me that it made sense for them to have like 50 or 70, I can't remember what the number was, because in that industry, there's a lot of small companies, right? And then we need to really, we want to get the whole market because it makes sense. I can't remember all the arguments, but I remember being swayed by it because he could defend it. Like there was an argument behind it. At the other end, someone who is 12 deals. And again, that's mindset-based investing. I know my bias is I'm super biased for small portfolios because I come from a world where we used to have small portfolios and being very hands-on into, right? Which doesn't make sense for VC. But that person, what makes sense is that there were 2 or 3 of them, and they had a kind of way to help the companies in advance ahead of investing. And they were happy having a small portfolio and being able to be very hands-on. They didn't need any money for a few years because they had made some money. So good for them, right? So again, I'm not saying it's working, But there was an argument behind it that we are doing a lot of work in advance. We know how to add value. We kind of reduce the risk at the moment we invest. And so we're happy having a small portfolio. Again, I'm not saying it doesn't work, but there's an argument. So we see I got challenged with that strategy 25-50. So you're right. What Michael Kim is saying is that I think I get that. What you mean maybe is that, is it what you mean is that, because of AI means you're probably going to have one investment and then the company is going to go big?
Sorry, Aram, yes. No, what I mean is that strategy of 5, 10 to 25 million doesn't really work, because in 9 years' time, the type of companies we will be backing, we can't probably today even imagine what they will be. And therefore, that kind of flat track of like, oh, I'm going to leverage my 4 years ago investment, there are high chances that we won't be able to leverage it, because the type of funds we want to raise in 6 years down the line will be very different. So in my opinion, it's that agility from one fund to the other, but we can't really guarantee that track record will be actually relevant to Fund 2 and Fund 3 as it used to be when it was only B2B SaaS. Hello, by the way, Aram. I didn't say hello.
Yeah, I thought it was you, and hi. Thanks for the comment. The stats I have comes again from Hostly Bridge and shared by Andreessen Horowitz. You can find it online, or in my LinkedIn is one of my last posts, is that the 5x plus funds have more losses than the 2x funds, but their winners are 70x on average, when the fund winner for the 2x funds is 20x. But what I've seen more is that it's not that they have more winners, it's that the winners matter more.
Andy, the strategy changed on a start fund that's under 1 million today. Andy, actually, you can use the thing to see how you should structure your sub $1 million start fund portfolio. So you should be kind of doing very small investments, right? If that's the case, and then it'll help you just kind of figure out how many.
I haven't checked if it works if you put less than one in a fund size, but the logic is the same. One thing I wanted to say, though, is that it's true that most of what Michael Kim is saying is true for, 50 million, 40 million, right? So that's why I built the metrics, is that when I was doing the training with GPs last year, everyone was saying the same thing. Is, yeah, but how does it relate to us? We have a 5 million fund. We don't have a 50 million fund. So that's why I built the metric. It works. I'm not sure it works at less than 1. It does work at 5, but the logic is the same. And hopefully for you, Andy, the good news is you don't need a big exit. You have, it depends on what your ownership is, but you don't need the big exit. Let's go back to the next bucket I want to show you about, which is the ownership. So we went through, as we say, initial deals and so on. And so now ownership, super important, right? And ownership, you kind of, I'm French, so I can be rude, right? You don't have an excuse for ownership, because there's a lot of data. There's a lot of data on ownership by stage, by geography. I mean, Carta is one. There's a lot more. So this is stuff where your portfolio construction needs to be backed by real data, external data. And I know some people maybe don't like Carta data, find the one you like. But ownership, you should know in your market, for your vertical, your stage, your blah, 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 what's the ownership that should go for. And ownership is interesting. I'm going to skip that, but because it's a bit hard. But basically what Michael Kim is saying on ownership, just so you know, right? But they've noticed, right, that there's a kind of correlation between ownership and fund size. Right? And what he says is, at seed, they just looked at their data, right? They're not saying it's what you should do. It's just they just saw that at seed, you kind of should have 1% ownership per 10 million of your fund size, right? So if you have an 18 million seed fund, which is arguably it's a large seed fund, you should aim 8% initial ownership. And at pre-seed is 2% per 10 million. So if you have a 10 million pre-seed, then you should have 2% ownership. I'm not super sure it works that well for us guys. So that's why you'll see that in the portfolio metrics, I'm mentioning here, if you go to ownership, I mentioned here ownership, Michael Kim heuristic not applied here, right? So I didn't apply it, but just so you know that exists, I'm going to skip it because it's not really relevant for us. But the ownership, you should have data on that, and you should be super convincing, because sometimes I see emerging GPs who tell me I'm going to have 15% of a pre-seed company for 50K. I'm super happy to believe it, but please show me the data. Okay, so that's ownership. And then same thing for dilution from entry to exit. There's a lot of data on that. You just apply what I said before, right? You just need to apply the Carta data, right? And you'll have it. So basically, ballpark is like between 30 and 40% between seed and an exit at Series C or D, right? So that's kind of easy to have. So I don't think we need to spend a lot of time on that, right? At the end, you multiply your exit by your ownership at exit to get your return, right? So that's super important.
And I think this kind of taps into some of the questions. People are asking, what's the right fund size, or what's the right this, or what's the point of this is for you to find the sweet spot depending on the investment thesis and the space you're going after and the stage that you're going after. So what we're saying here is the type of exits that you're likely to have in deep tech are maybe different to the ones that you're likely to have in climate tech or fintech, that are likely different than you like to have in underrepresented founders or whatever. So what you need to be doing is kind of checking and validating that whatever you're saying your strategy is going to be in your portfolio, that it's grounded in your sector that you're going after.
Exactly. And thank you, Myrto, because yeah, if you read the post, that's what you'll see is exactly what you said. Is what I'm saying is it probably doesn't work for everyone and stuff, but this is going to help you convince LPs that you have the data to back up the strategy and have a rational discussion on these are my assumptions. This is the result, the exit I need. And by the way, I can have those exits. As Myrto was saying, very rightfully so, in deep tech, in Germany, in France, in the US, and whatever. But if you're using exit value, if you're in the US, for example, yeah, I mean, there is data. David Clark is a great fund of fund investor at VanCap in Oxford. He has some data out there. Yeah, I mean, median is 85 million exit, top 10%, 400 million, top 1%, 1.4 billion. So if you're going for a kind of middle of the meal strategy and you need a 9 billion exit for your strategy to work because you went with a big fund size, because you promise also a huge return investment, just make sure that you're in the realm of what's possible statistically has been proven, right? So this is exactly what Myrto was saying is once you've done all your assumptions, do it like bottom up, like do all the numbers and then look at the number it gives you. And if that number, you can back it with, there's a 15 exits in my investment strategy in the last 10 years. I feel good about it. Good for you. If it's a stretch, be ready to defend it. If you can't defend it, it means, LPs are probably going to pass because you can't really convince them that your strategy makes sense. Hey, Samir, how are you? Samir, I think you used it, right? And you had some good criticism on it.
I do. I use it, and it was very useful for me to make sure that my assumption about my portfolio was robust enough to present to a sophisticated LP. I would say people who invest for the first time in VC, that was easy. They didn't even raise the question, but as soon as you go for a fund of fund or institutional LP, they really go deep into those questions. So it was super useful. Thank you very much, Aram.
No. First step. Yeah, go ahead. Sorry.
How does it apply to biotech?
Doesn't.
Structure apply?
That doesn't. Sorry, Brian. It doesn't. The problem about biotech that I know of is for us is a different pocket because you guys, what you do, you have those, clinical trials and so on. The valuations are huge to start with. You don't probably have an exit. You don't need a product that works as far as I understand. You need the molecule to work and so on. So unfortunately, I should have prefaced it. This is really more like, your AI/digital kind of startup position.
Aram, do you have kind of any closing remarks or advice for emerging managers before we wrap?
Love what you do. And if people are, on my website, I have a lot of webinars and so on. If you guys think, there's this thing, for example, the investment thesis, we can talk about that. Reach out to Myrto. Her LinkedIn is going to be full. And tell her we'd love to have a session on this and that. I'm sure you probably have sessions planned for the whole 26 and 7. I see you're very active, but if you have some spot, I'm super happy to come back.
I would love to do something together again, Aram, for sure. All right. Thank you, Aram. Thank you everyone so much for showing up and hopefully see you next time. Bye-bye.
Ciao.